phases of a bull market and that we have probably entered the final phase. As gold soars, and it should be putting in most of its gains in a very short period of time. So the dollar's portion can sort of fall off a cliff because gold skyrockets. The portion of what is left as far as bank reserves, and then countries are trying to abandon the dollar as far as their currency reserves. They are worried about the dollar being a weapon. And so, that's one of the reasons for the steepening that you see once it crosses the 50 level, that black line. It crosses that, and then it's much steeper there. And so that steepness may continue.
We've most likely entered the final stage of the gold bull market, in which the majority of gold's gains will occur quickly. As gold prices rise, the US dollar might plummet sharply. This is being driven by diminishing bank reserves and a growing global rejection of the dollar as a reserve currency, particularly due to concerns about its use as a geopolitical tool. Once primary technical levels, such as 50, are crossed, the rising momentum in gold and the sharp collapse in the dollar may accelerate dramatically. Mike Maloney, an author, investor, and founder of goldsilver.com, emphasizes that U.S. bonds play a crucial role beyond investment. They're essential to the global financial system's functioning. He warns that if too many investors are shorting the dollar, a reversal could occur, as crowded trades often backfire. He also explains how the Eurodollar system, dollars created outside the U.S., adds opacity since much of it isn't captured in standard U.S. monetary metrics. Foreign banks still rely heavily on US Treasuries, even as the global dollar standard gradually weakens. The speaker, who's predicted the end of dollar dominance since 2009, sees it as a slow, ongoing process. He laments the U.S.'s growing role as a global bully, contrasting it with the admired image of America after World War II under leaders like JFK. While a chart may appear dramatic, it's essential to read it correctly. The dollar's share didn't drop as steeply as it seemed. It went from 58% to 44%, not to 8%. Meanwhile, gold's share of global reserves rose significantly from 11% to 23.5% since 2017. This increase is partly due to central bank buying, but it is also essentially a reflection of gold's rising price, as the data is measured in dollar value, not ounces. The speaker sees this as a positive trend, especially since they're personally invested in precious metals, particularly silver. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
U.S. bonds are used for much more than just investing in as savings. They are the plumbing in the banking system. They're, all of these banks, the Eurodollar is big. There's a lot of dollars created outside the United States that we can't measure, by generating charts on the Federal Reserve. They hid the Eurodollar from us quite a while ago when they hid the old version of M3. They've replaced it by a new version of M3, which is actually just M2. And so you can't paste those charts together and get a real historic picture of total number of dollars out there, which is impossible to calculate. The point is, even foreign banks need US Treasuries. And so, I've been predicting the death of the global dollar standard, and it is coming. I started doing it in 2009, and you can see these nails in the coffin, but it's a process. It's going to take a while. And yes, we keep on doing things. I wonder, over the past month, how many more people we turned into enemies of the United States, that they now hate us. We keep on going around the world where we have become the world's bully, and bullies typically aren't liked, and it's too bad. I remember during President Kennedy's we had come out of the World War II. A lot of the world, they loved Americans. We sort of saved everybody, and we're doing just the exact opposite these days. I think it's disgusting. It's a mixed bag. I agree with it, but I don't agree with it. It's gonna take a while. Well, this sort of surprises me. I wonder, 20 years ago, everything was like at its peak. January of 2005, that was party time. That was when the real estate bubble was really gaining some steam, and the stock market was getting overvalued once again. If everybody is short the dollar, then this sort of suggests that it might go the other direction. Usually when everybody gets on one side of the boat, the first thing you look at when you look at a chart like this, you see it going, the dollar going from like almost 60, it goes 58. And then on this side, it goes down to 8. Well, no, it doesn't. You got to know how to read charts. It's going from 58 to 44, basically. And so there's something a little bit exaggerated about this, where gold's share has gone up from 11 to 23.5. Now a lot of gold's share has been central bank purchases, but it is also just the change in the price, because they're not measuring this in like ounces, they're measuring it in dollar units. So what percentage for gold to have gone from 11% to 23% is actually pretty impressive, and that is since 2017. So I think this is great. But then again, I'm invested in gold, so well, more so in silver. But
Mike critiques the term stablecoins, pointing out that they're only stable relative to the US dollar, which itself is constantly losing value, especially when measured against gold. They argue that since the dollar isn't truly stable, calling these assets stable is misleading. They also mention past failures in the stablecoin space, where flawed mechanisms like mismatched backing or poor design led to sudden collapses and billions in losses, not as wealth transfers, but as complete evaporations of value. Lowering interest rates will not significantly reduce the national debt, as politicians are likely to spend any resulting savings quickly. Accurate debt control, they say, would require removing political influence altogether. They also point out that projections showing savings by 2030 are misleading, as most improvements appear only in the final years, making little real impact. Additionally, distrust in the US dollar surged after the US froze Russian assets during the Ukraine conflict, prompting central banks globally to prepare for a post-dollar world. Now, let's recall the interview.
So by these stable coins, so they're supposed to be backed by treasuries. So what are they stable against? US dollar. That doesn't mean they're stable. Where's the dollar going?
Exactly.
I mean, all you have to do is look at the price of gold, flip that chart upside down, and you've basically got the dollar as measured by gold. And the dollar always loses value. And so it's not stable. You shouldn't call them stable coins if they're stable to the dollar. Just because he's jumping back and forth like this, and so many people do, it just suggests that he doesn't know quite as much about it as he's claiming. Yes, it is right. And like I said, stable compared to what? The dollar is not stable. And we know that it always goes one direction. It bounces up and down against other falling currencies. So yeah, let's just move on to the next one. I think they're trying to regulate this. There was a stable coin that blew up a few years ago. And I can't remember what the system was, but they've got the stable coin and then some offsetting coin, and something just got out of whack and the whole thing imploded, and several $1 billion vanished instantly. And in this case, it literally did vanish. It didn't, it wasn't a wealth transfer. It was just opening up the drain in the bottom of the bathtub. It was all gone. So I got to stop you right there.
Suspicious.
How is it going to rein in the national debt? Yeah, if it lowers interest rates, we're going to be paying less interest, except if it saves anything, a politician will figure out how to spend whatever it saves faster than it can save anything. So no, it's not going to rein in the national debt. The only way to do that is get rid of all the politicians. I don't know. Yeah. Well, agreed. And I'm just noticing by 2030, 5 years from now, the savings are not all, look, 50 trillion something. It's not that much savings. It all seems to happen in just the last few years on that chart. Very interesting. So it's not going to make that much of a difference. He's making the claim it's going to drive demand, which will lower interest rates. But basically, the politicians are going to how to get us deeper in debt, regardless of what happens. Absolutely. And you see how it really launched there with the Russia invades Ukraine. It wasn't Russia invading Ukraine. It was the U.S. confiscating assets that were considered sovereign assets. And the U.S. Basically caused a lot of distrust with the dollar. And this is the central bank's reaction around the world, is they're getting ready for something. They don't trust the dollar anymore.
Mike Maloney presents a compelling case that we are entering the explosive final phase of the gold bull market, driven by eroding trust in fiat currencies, declining U.S. bank reserves, and the global shift away from the dollar. He warns that despite the dollar's lingering dominance, its role is shrinking, while gold and silver are quietly reclaiming their historic place as true stores of value. As central banks diversify, geopolitical tensions escalate, and systemic cracks deepen, the stage is set for gold to surge sharply and for a global-scale monetary transformation. Will central banks continue to buy gold at a record pace if the dollar weakens further? Could the decline in stable assets tied to the dollar trigger a broader loss of confidence in digital finance? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed.